Millions of Aussies invest in the share market, but it's not the only way to put your money to work. Yes, the share market offers potential for high returns, but that also comes with an extra bit of volatility. That's where global private credit comes in, one of the fastest growing asset classes in the world over the past 15 years. Global private credit is a form of non-bank business lending on a global scale, and it is much more diversified than Australian private credit. There are limited global private credit providers in Australia. One option is Term Plus. Term Plus target returns are tied to the RBA cash rate plus a fixed spread. Returns can be paid to your bank account or reinvested for compounding. Head to termplus.com.au for more information and to read the PDS. Remember to always consult a financial advisor to find the best fit for your financial circumstances and goals. I'm proud to say that this Rask podcast episode is brought to you by PIMCO, one of the world's leading fixed income investment managers. With more than 50 years of experience in navigating complex global markets, trillions of dollars under management, and a global team of experts, PIMCO is a name trusted by investors worldwide. Discover how PIMCO can help you build a more resilient portfolio at pimco.com/au.
Welcome back to the Australian Retirement Podcast, your source of financial goodness every Thursday. I'm here once again with my good friend and co-host, Drew Meredith. G'day, mate.
Good to be here as always. Very excited for this one.
Yeah, this is going to be a good session. We've got lots of good stuff to get into. We're going to talk about AI, we're going to talk about gold, Division 296 changes, which are huge. And we're also going to talk about your trip to Gippsland, right?
Yeah, what could be more topical than AI, gold, and
Gippsland?
Diesel petrol? Must be filling up the car with fuel at the moment. Yep.
Happy days. Where are you going?
Not sure yet. We have an end destination which we aim to get to in a single day, and then working our way back. And there's, the world becomes your oyster. And I feel like this could be one of the, maybe we need an episode on this. And anyone listening, can you send feedback? Do you have pub reviews? Do you have meal reviews? Do you have places to stop? Because Gippsland is a very big place. So the aim is to get to, I've never done the oyster tasting in, like in the, what do you call them? I'm not going to say that word. That's the wrong one.
You're on your own here.
Like you have the overalls, the waterproof overalls that you stand in, you drink champagne and you taste oysters. So we're going to Merimbula, the long, down along the long way, which I know there's lots of great fly fishing places, but don't have the patience for that yet. The aim is to get there and then work our way back. So Tath, I've heard a lot of good things about the Tathra pub up on the hill. I've heard good things about Malakuta. From Malakuta to Meetung, haven't heard much. So any feedback would be greatly appreciated. And hopefully the weather's great. And I'd like to do, maybe I'll come back with a couple of reviews of some pubs, some hotels, some schnitties on the way. Once you get to the border, does it change from Palmy to Palmer or Palmer to Palmy, or do we just keep doing the same?
It does if you go over the SA border.
And is it schooners?
Oh,
does it go from pots and pints to schooners?
It definitely does. Yeah. Okay, well, this is an interesting thing because, our listeners would actually, a lot of people who are travelers, and we've got quite a few grey nomads that are listeners. So we want to tap into your superpower of knowledge here. It's time for you to finally give back. You've been sitting here just taking from us. We need your intelligence and value now. So please, we want some recommendations.
Then you're not sitting still either. Did I hear is your birthday coming up too?
No.
It's your friend's birthday.
I've got a really good mate who's got a milestone birthday. Right. It's his 40th coming up. Ooh. And we're heading off we're heading off to Daylesford for an overnighter to go fishing, which my wife pointed out sounded pretty suspicious, two two married middle-aged men.
Get pampered.
Yeah, that's right. Yeah, so we're just going to enjoy the beautiful aromas of Daylesford.
Some massages and
it's going to be great. And then the next day we're going to go and do some fly fishing. So we'll see how we go.
And for those playing along at home, it is a Tuesday when we're recording.
This is not a weekend. Well, his birthday falls on a Wednesday. What can I do? Now, we want to jump into some big things here. One of the obvious things is around AI. We said we're going to talk about it.
It's been huge.
Incredible how sharp the growth has been, how pronounced it's been. And very recently, we've started to come across some enormous and pretty scary numbers. There's some good data that indicates that the AI bubble is, or if we're going to use that language, like the growth of AI is now perhaps significantly larger than what the .com bubble was in the early 2000s. And so we end up with this challenge whereby we say, well, yes, we have huge valuations here. and on traditional earnings, unless you justify these share prices based on future earnings, they look very, very expensive. And despite that, they keep hitting their earnings targets and they keep growing. And so the question is for retirees, like, what do you do here? Do you stay invested? Do you get more invested? Do you take a more conservative path?
I don't think you have a choice, really. Like whichever approach you're taking, if you're investing and if you're invested through an industry fund, through an ETF, through anything, one of your biggest exposures is to this AI theme. If you hold Alphabet, Google, if you hold Meta, if you hold Amazon, Nvidia is the biggest company in all the major US share market ETFs. So you've got an exposure. You need to have an interest. And I think generally you need to be exposed to this. Doesn't mean you need to be exposed to it completely all in one or two companies, but you need to be exposed to this artificial intelligence theme and the different legs and thematics that come off it if you want to have any hope to, one of the most important things when you're investing or trying to self-fund your retirement isn't just the income that you're getting, but making sure your capital is keeping up with inflation and, increasing the probability that your capital or your money outlasts you as opposed to you outlasting your money. And one of those is being exposed to the themes that grow faster than the global economy itself. And I don't think you have a choice. That doesn't mean when we say bubble, I think you can call it a bubble. It doesn't mean the bubble is going to pop tomorrow, and it doesn't mean the bubble is going to pop in the traditional way that it did in .com. I mean, call it traditional. It's 25 years ago now. So I think it's fair to call it a bubble, and I think there are growing risks. If you think about there's something, it must be like at least $500 billion in investment into data centers or chips in the last month, 2 months alone. But there's huge execution. That's an investment that's going to occur over the next 4 to 5 years. There's massive execution risk on that. And I think there's a multitude of different ways that people can be investing into the artificial intelligence theme. I thought it would be interesting, though, because everyone always says it's overvalued on traditional multiples. But if you go back and look at the headlines from the last 10 years, cyclically adjusted P, everyone calls it the CAPE ratio, which is supposed to tell you if the market's overvalued or not. It's pretty much said the market's overvalued every year for the last 10 years.
Yep.
And during that period, I'm pretty sure the S&P 500's returned over 10% per annum over that period. Like it's kind of if you listen to all the headlines, you'd be, shoveling into gold.
Well,
which people, let's not go there too soon.
We're definitely getting there, yeah. I'm reminded of that wonderful expression termed by John Maynard Keynes, who said markets can remain rational longer than you can remain solvent. Yeah, and so this is one of those circumstances. Like I've spoken to people who are thinking about shorting positions that have significant AI exposure in the, we'll call it hope, that there's this rebound the other way.
There's some sort of execution, yeah.
Now, if you get that right, you're going to be a billionaire, depending on obviously your
very
investment.
few.
But for example, if we think about what something is becoming better and better documented, which is that of the major AI companies, there's an astronomical amount of overlap in terms of the way that they support one another, both in terms of supply chain, but also financially from a lending perspective and from an equity perspective. And so that creates this knitted risk whereby I think it might have been the AFR recently. I was reading a piece that was talking about if we were to identify a major issue with the large language models that we're using right now, if we could uncover a major issue, it would impact close to 90%, like significantly detriment, perhaps decimate up to 90% of that AI bucket.
Story. Yeah.
That now, so they're the wholesale risks. We have what you'd have to describe as relatively new technology in a long-term investment sense, which is astronomically adoptable, and that's why so many people have moved to it. That's why the returns have been so sharp in portfolios, and we really are still only at the very forefront of at the very beginning of how we can adopt our large language models to optimize the efficiency of all of the things that we do. So there's lots and lots to be excited about. That's why the share price growth in so many of these shares has moved. But again, it's one of those things where if it continues to grow and grow and grow, there will be a time when we start to look at this and say, okay, well, we now should become a little bit more cautious about how we take this approach.
And that's why we talk about it. We've always talked about it. And I think you can go back to, it sounds bad, but you go back to the gold rush, and there's fund managers that have a great way of making this story, which is you don't the same. Yes, there could be cyclicality. We feel like Nvidia is not a cyclical company anymore. But there is, back in gold rush days, you didn't necessarily want to invest in the gold explorer because there was no guarantee they found gold. And even if they did, it was going to take them a significant amount of money to even get the gold out of the ground. So what they started talking about is investing in the picks and shovels. So the people who sold the picks and the shovels to go look for gold or to dig gold out of the ground. This is not I'm trying to get better at my stories.
I'm loving this.
But I think I always put myself under pressure because I don't prepare these before we go on air. But basically, whenever there's a major theme like this, there are all different ways you can play it that potentially have less risk, that allow someone like a retiree, where in my experience, you want to have a less volatile experience, which hopefully reduces the risk that they make an emotional decision and sell out of share market. So if Nvidia fell 50%, which would send the SP down heavily, everyone has a reaction at some point that they need to sell it. So how do we avoid that? And it's trying to find as I said, the picks and shovels, or the sideways themes that come off this. One of those, which is kind of growing in interest, but it hasn't had the exponential takeoff that AI, chip makers, automation, all these other companies around AI have, is infrastructure. So energy, if you think about all the AI-powered all the data centers are going to be powering AI, they need huge amounts of energy. Yes, nuclear has been popular, but whether that's deliverable or not, just general energy, the transmission of energy and energy companies, essentially. And what we've found in the past is that incumbent companies tend to benefit from the increase in demand for energy, as opposed to a brand new company trying to build $1 billion power plant next to a data center. And in addition to that, another type of infrastructure, which we haven't thought about if you're investing in infrastructure 20 years ago, it's toll roads, it's airports, is actually investing to own the data centers that everyone else is leasing off you. So you're owning the property, you're owning the core part of that, but you're not taking the risk of whether the data center is deliverable, whether the chips can be delivered on time, and whether the customers actually come for all the computing power we're bringing. And that's only one leg and one theme that you can pick out of this.
Picks and shovels.
Yeah, picks and shovels.
Well played.
Hopefully that story resonates with our audience.
Well, my criticism then is, why do you not own the picks and shovels in your own portfolios? Because we're going to talk about gold now, and something that I was blown away at, really impressed at, is that we're talking about your portfolio, and you were saying that you've held gold since 2016 and you still hold it in your portfolio. So to confirm, not Drew Meredith's portfolio, but Wattle's portfolio.
Yeah. I believe I have a small portion in my super fund as well. Yeah, I mean, this is probably the hardest investment recommendation we ever made. Like when we do quarterly reviews for our clients, we try to find, and particularly retirees, you try to find a diversifying, non-correlated asset, and we have to sell this idea to people. So we sell it to, we have 200 clients. We have to go talk to all 200 clients and say, we want to buy gold. People just looked at us like we were crazy. Advisors within our business thought we were crazy as well. Like, this is when gold was $1,600 Aussie an ounce. It's now 6,000 an ounce. And most of that's come in the last 2 to 3 years. For the vast majority of that time, I think it was sitting on like maybe an 8% per annum return, which was solid in an environment where share markets had a couple of sideways periods as well. But recommending gold provides no income, and everyone doesn't, no one thinks it has an intrinsic value. And interestingly, some of the reasons we put it in place at the beginning was we were concerned about deflation, we were concerned about interest rates, we were concerned about geopolitical uncertainty, and this is in 2016. You've had the taper tantrum, you've had quantitative easing, you've had a pandemic, you've had all these different things have come along, and it's actually been really the last 2 to 3 years where it's taken off exponentially. But long-term holders in gold, basically, there's a more difficult question coming now, which is, how do you buy? Is it worth buying, or is it appropriate to be buying significant amounts of gold into portfolios now? So back then we had about 5%, so a real true hedge. But 10 years ago, the access to alternative investments, you'd probably agree, wasn't particularly broad or good to be able to access non-correlated investments that we're looking for. Am I still crazy?
Well, the question is, are you looking to retain it in portfolios, or do you think you'll gradually exit out of it?
I think naturally, and this is my own biases, because it's done so well, I naturally think about selling. But because we do quarterly reviews, we've been trimming it for people that have grown into large positions. We've been trimming it during that period to bring it back to an appropriate position. So we don't have 20% of a portfolio sitting in gold because we've let it run the entire time.
Bet you wish you did.
But then currency becomes into that question as well. And that's, we could do 4 episodes on currency. We're in unhedged generally, which means a falling Aussie dollar has been benefiting the value of gold. So it's 6,000 in Aussie and 4,000 in US dollars, I think. I got asked on the Australian Investor podcast, buy, sell, hold. I think it's a hold at the moment. So trimming, making sure it's appropriately positioned. If you're adding very slight, like not expecting the returns of the last 3 years, if you're adding, expect the long-term return, which I think is more like 7 to 10% from gold as a hedge. But I still think non-correlated, and clearly people are concerned about, as you were saying, valuations of share markets, valuations of property, basically valuations of every asset, and they're just searching anything they can as a hedge.
Yeah, not to mention peak, not peak, certainly nowhere near peak, but we've got geopolitical risks that exist in this landscape that are meaningful, and they really are creating an environment where people are looking for safer assets. And gold has always been, historically, for a long time, to say it differently, gold has performed well in poor geopolitical backdrops.
Yeah, and you did some research, some background research on this too, about where gold moved.
Oh, yeah. Right, yeah. Thanks for that. Thanks for that nudge. So it's an interesting perspective that you've got, and I have to hand it to you because it's obviously a terrific play that you've had for a number of years with Wattle. I'm similar in the sense that I think if you're holding gold, if you already hold it, then holding onto it as a momentum play, like it's already got momentum. And we just spoke about the idea that markets can, even if gold is irrationally overpriced, markets can go tremendously irrational. Having said that, if you don't hold it, I certainly wouldn't be acquiring it. And the thinking around that is the way that gold moves in nature. Most assets you were talking before about fundamentals. Most assets have fundamentals, and for those listeners that might be a new concept, the idea is that you can peg the price of the asset to some core reasoning or philosophy or approach. And the most common one would be what income you derive from it. So let's take a really simple example whereby you've got property A and property B, and they're in the same suburb and they're relatively similar age and similar quality. If property A is earning $1,000 a week in rent and is worth, for simplicity, $1.5 million, we'll call it $1 million, keep the number simple, and property B is earning $2,000 a week in rent, then all things being equal, the natural valuation for property B should be double that of property A, should be $2 million. Yeah. And that's a fundamentals-based valuation. Now, of course, every different asset is going to have different circumstances, and how close is it to amenities, and what's the quality of the asset, and how many bedrooms does it have, and all those sorts of things, depending on what type of property it is. But also the counter argument to that is that all of those things should be baked into the income, because if you had a rundown property, then you wouldn't be able to charge $2,000 a week. You'd be charging $1,200 a week or something different, depending on where you are, of course. So the challenge with an asset like gold, and we've seen it also when it comes to cryptocurrency, is that there are no fundamentals. Gold doesn't pay you a regular dividend that you can match that against other assets. And of course, neither does, for example, Bitcoin or Ethereum or those sorts of assets. And the advantage there is that when they go on a run, they can go on a really, really strong run because you don't have the fundamentals to say this is getting out of control. If we go back to property B and we say, so property A earning $1,000 a week in rent, worth $1 million, property B earning $2,000 a week in rent, and that's worth $8 million. At a certain point in time, well before then, you would look at it and say, hey, that's miles overpriced versus the comparative income that I can get from other assets. And so it gets at least not so much weighed down, but held back by the fundamentals. Whereas if there is no rental income for either asset, well, now you can just, whoever's willing to pay more for it is going to end up buying it. So this is both a blessing when it's on a run, but it also can be a curse, because if it turns the other way, you can see the inverse, which is people say, well, who's to say it's worth, for example, $4,000 gold? It could be worth 2 or 1, and then you get that uncertainty on the other side. Now, speaking to this chart, I was looking at the last time gold had a really strong run, commensurate to the run that's on. It's had 3. The first run was from 1970 through to 1980.
Stagflationary period, oil shock, Bretton Woods. Currency hedge? No, that's when the Aussie dollar.
Correct. Yeah,
moved off the gold system. That was Bretton Woods.
Yeah. The second, to confirm, was early 2000s, very early 2000s through to about 2012.
Yep.
And of course, if we think about that time, we had dot-com bubble. We then had, despite share markets moving, we had the GFC. We had an Iraq war, so we had that geopolitical uncertainty. And then it trended downward toward about 2018, and then we've seen another significant run from then until now.
Even just the last 6 months has been
wild. Yeah, super, super strong. However, let's take a moment to observe the peaks to troughs thereafter. If you held gold at its peak in September of 1980, and then of course it falls, and so now you have to sit around and wait until, or you make the decision you're going to wait until it reverts back to the same $670 an ounce that you paid for it. You need to wait until 2007.
Yeah.
27 years of gold being worth less.
Interestingly, the peak of another market cycle, share market cycle.
Correct, yeah. Now, if we go across to 2011 and we think about the peak of early 2012, and then similarly, the time frame is a little less. In this case, it's around about 8 years, 2020.
Yeah.
But the point is that when gold does trace back, you can, especially for a meaningful trace, you can see very, very long periods of not getting your money back. Now, this is one of the reasons why I put it to you that holding over the long term for an equities market is more likely to derive a positive outcome for you, because the fundamentals of the equities market in terms of what income is being derived from these companies, that's always growing. Economically, things are moving. And so naturally, the share prices of the constituents of, for example, an ASX 200 or an S&P 500 will continue to grow in value over time. Whereas the idea that you could hold an asset for 27 years and have no growth and no dividends, it speaks to that consequence of being held in an asset. Sometimes it's going to do remarkably well and then have long periods of being in the doldrums. So if you're holding, by all means, feel free to hold. If you start to see it trace back the other way and you are of the view that that's a meaningful trace back, it would, in a lot of cases, it would be a mistake. Looking historically at gold, there's only been a few times in its history where it's tradable history where we've got a valuation on it, whereby it would trade backward for a period of, say, 12 months and then rebound and then go off on a tear.
Yeah.
Typically, when it trades back and it trades back beyond that 12-month period, it's going to sit there for a longer period of time because it speaks to the fact that it's become overvalued at a certain point and it's now coming off the boil. Thanks for watching this episode of the podcast. A common question that we get at Rask is, how do I need to be prepared if I want to see a financial advisor? There's a few things that stand out that may really help you if you want to get the best from an advisory relationship. The first is to come prepared. It's really valuable if you can arrive at that meeting with a good sense as to what you want to achieve from an advisory relationship. Now, there's lots of different financial advisors out there that operate very differently. And if you don't have a good sense as to what you want to achieve, it can be kind of easy to get pulled into their advice philosophy and their approach. It can be hard to define what is the best advice relationship for me. So whether it's you or you and your partner having a good conversation to say, what do we actually want to get out of this? That will really, really help you to know that you're in the right place when you sit down with your advisor. The second one is to be open-minded. You may very well work out that there is one or two specific things that we're looking to address with our financial life. But a really good financial advisor is going to be thorough. They're not just going to look at those things. They're going to be as exhaustive as they can be about your entire financial life and make sure that everything is lined up and set up the way that it should be. So when you go into that process, please be open-minded that the highest value that you might get is not necessarily solving those one or two acute things that you wanted. The last thing is to be curious. If you are watching this podcast, it's probably because you are watching or listening. It's probably because you want to learn more about your finances. You want to level up when it comes to your education. And if you're going to meet with a financial advisor, it may be your first opportunity to transition that general knowledge that you've developed about your finances into your own situation and how it applies to you. So be curious. It makes sense for you to try to understand as well as possible, how do all these things work for me? Because at the end of the day, it's your financial journey and it's your money, and all of the advice should be helping to serve your unique situation. Now, if you want to learn more about how to get the most from your advisory relationship, you can either scan here, and that will take you to a guide that gives you a heap more information. Alternatively, if you scroll down below, there is a link to a Northeast Wealth page that we put together not too long ago, and that similarly outlines the key things that you should be doing in order to get the very most from the relationship. Thanks again for watching this episode of the podcast. I'm James O'Reilly from Northeast Wealth. We hope you enjoy it.
Yeah, I think a key there is that most of the times where it did nothing were generally good economic conditions. Like there was nothing, yes, there are little bits of geopolitical risk, but they were generally smooth economic conditions, markets were performing reasonably well, interest rates are at normal settings. Because you look at, everyone says it's an inflation hedge, but then you put gold against inflation, it's not an inflation hedge. Everyone says it's bad in falling rate environments, it's bad in increasing rate environments. Like there's always a story. There's not hedged directly to anything. I think it's more of an uncertainty, and for Australians, a bit of a currency hedge that you can use as well. This is, again, I'm kind of riffing off here, but I found it interesting that gold's done so well, even though there are expectations that crypto would be like the new form of gold, like the digital form of gold, that it's an alternative, as you said, doesn't have any income. I mean, if you leverage it like people do, you can generate income. That's like anything, if you structure it enough. But I found it interesting that it's done exceptionally well while crypto has also done well, whereas it was such an expectation that people would just turn to crypto and gold wouldn't have a role anymore. So it's kind of overcome all those risks. But I think anytime you're holding an asset like this, you have to be prepared for down periods, but that's what hedges should do within your portfolio. If that's a sideways period for 5 years, this is why you have a hedge, because when things go bad, gold tends to outperform, or non-correlated assets should tend to outperform, and that's why you hold them in the first place.
We've got to keep moving, but I heard an interesting argument about this a little while ago that was talking about the important fundamental properties of money. This argument of should gold be a currency and what constitutes a currency. And so the key things that stood out here were fungible. So of course you capable of substitution and interchangeability. Gold, of course, can do that. So can crypto.
Yeah.
Durable, able to stand repeated use. Yep, similarly, both can do that. Divisible into smaller units. Yes to both. This one was interesting. It's the concept of portability, easily carried and transported. Now, both are portable, and you could make a very good argument to say that crypto is more portable than gold in the sense that you just need a USB or the codes in your own head, and then you're good. Whereas gold takes some effort to freight and carry around.
You have to pay a staff.
But having said that, the gold is portable in the sense that under no circumstances does it become non-portable.
Yeah.
Whereas
and every country accepts it.
Correct. Yeah. Well, that comes down to acceptability, which is next. But it's interesting how when it comes to portability, you look at crypto and say, well, it's extremely portable. Yes, it is. But if you can have structural challenges or systemic challenges that significantly impact its portability, whereas gold doesn't have those problems.
Like if your internet goes down.
For example, yeah. And the last one is around scarcity. So there's acceptability. Most people accept the money as payment. I put it to you in today's climate that people would accept crypto more than they would accept gold. There are plenty of crypto crypto ATMs out there. I haven't yet to find a gold ATM.
Yes, because it'd be an entire building in concrete support and everything to get you $4,000 coin out.
And the last one is that, of course, it has to be very scarce, which in both cases applies. So yes, agreed, but I think there's still room for both. Let's keep moving, if I may. We're going to jump across to the relieving news of the change of Div 296. Thank God. So, mate, as a reminder, Division 296 for everyone was the idea that people with super balances above 3 million were going to be taxed till the cows come home in every which way.
It was over. I mean, we were in the Rask office, and I think someone brought it up at this point that we all feel relieved by it now because of how bad the original policy is. That if you make something really bad and you get dialed back from it, like the Trump negotiation tactic, then everyone's, oh, great, yeah, this is exactly what we expected the entire time. So, yeah, I mean, we went through this, we ranted, we did YouTube videos, we did shorts, we did everything, we did articles. I think you were quoted in the Fin as well on this topic. But basically, if you individually, so per person, if you had a balance over $3 million, the proportion of the earnings representing the balance over $3 million were going to be taxed at an extra 15% on top of the 15% accumulation tax that you already pay on the excess that isn't in your pension account. And again, there's always a little bit of complexity here. And the $3 million, technically not a cap. You're not forced to take that money out. So it's just a cap on the tax rate essentially, or a means, you call it a means tested or a marginal tax rate for superannuation now, just assessed on assets. But the big problem was that they were going to tax unrealized capital gains. So that's like we own a residential investment property. The property gets valued. It's up from $800,000 to $1 million, and I have to pay tax on the $200,000 gain I made.
Despite the fact that you don't have any money.
I haven't sold it. Yeah. Still just getting the same 1% income out of my residential property, as I always have. So tax on unrealized gains, very rare in the developed world. I think only in one other country is it executed in that way. Someone made the point, but land tax is a tax on unrealized gains. I think that's slightly different. We won't go into semantics, I think, today. And the other one was that the cap wasn't being indexed. So like every other cap that exists, pretty much every other cap, the total super balance cap, the transfer balance cap, it's indexed to inflation, which means if the cost of living, if inflation keeps going up at appropriate periods, that the cap has got, the concessional contribution cap's gone from 25 to 27.5 to 30. That was not the case for Div 296. But
well, I'll add to that a lot of people looked at that $3 million cap and said, oh, that's not too big a deal that it's not being indexed. But we ran some modeling to say for Australians that we'll categorize as middle class Australians, so many of those Australians would get caught up by this net over time because they've had 12% superannuation for the entire duration of their working lives, and their super balance just goes above 3 million over time based on investments and contributions. So having that adjusted is different. You said but, so there are some big changes here, and I think some pretty logical changes too. As you point out, the most important one for mine, or the most important two, firstly, we are not going to have any gains that relate to unrealized assets. So unless you're selling assets, then you are not going to have gains on those. And that just is sensible in the sense that is consistent with the grain of all other Australian tax legislation.
I think auditors around Australia have just had a sigh of relief.
Agreed. That was going to be hellish.
Yeah.
And there'd be so many questions about how do you of course, because everyone would be motivated to value assets lower than they are to pay less tax in those times. It would just be messy as hell. So that's number one. The second thing, of course, the 3 million is now going to get indexed. So happy days. We finally have a start date. Now, originally the Labor government had proposed 1 July 2025, and then we collectively, everyone in the finance, like accountants, auditors, advisors, were saying, so it's 1 July 2025.
What's happening?
And
they're going to retrospectively do it?
Correct, which would have really hurt people that had money above 3 million in this financial year. And so that left a lot of people with just a lot of uncertainty, and we had to say to our members, logically, the government shouldn't do this, but the legislation was suggested 1 July 2025, so they'd need to change that. It's already passed the Senate, but it would seem very unfair for them to make that adjustment, to not make an adjustment to take into account that they've taken longer to deliver on this legislation.
I reckon I spent hundreds of hours explaining to people and convincing people not to make a decision. Like clients with over three, like that will be impacted by the cap or worried they're going to take money out, they're going to put it in bonds, they're going to put it in companies, they're going to put in family trusts. They had to make the decision, and it be kind of like fever pitch within these kind of like friendship groups. And the advice is always for both of us, until there's something written in legislation, do not act. Like that part is very simple. But I mean, if I could send a bill to the federal government for like 1,000 hours of time that we spent discussing why you shouldn't act on legislation that is not yet in force.
Well, to be clear, you can send a bill to that. It's just unlikely to be paid.
Get paid.
It's worth trying.
They might chase me up.
So there's another big one here, which comes for those people who have balances above 10 million. This is totally new, a new proposal. Now, I know, let's take a step backward, because we were talking about legislation and explaining that the original legislation or the proposal was put forward. It passed the Senate, but it didn't go through the necessary steps to be legislated. So because of that, before it had gone through House of Reps and then eventually got royal assent, before those steps, now the proposal is to change it.
Yeah.
But importantly, it is still a proposal. I think the reason why most advisors feel a sense of relief here is that this proposal is much more aligned to reality, and there's now a reasonable likelihood in my eyes, certainly, that the actual legislation is probably going to quite closely match what the proposal is.
Yeah.
Whereas the first proposal that came out was so mind-bendingly unusual that there was a genuine state of disbelief. Can you get the legislation through? Like, yes, you've got the numbers to get it through, but from a lobbying perspective and the pressure that you're going to get for doing this, plus the fact that it makes no sense, what are we going to do here? So, although the fact that these are still proposals, we note that these proposals in ours have much higher conviction that they'll materialize. Let's go across to the $10 million cap. If for those very fortunate Australians that have got superannuation balances above 10 mil, you've done some good numbers on this, these people are going to get hurt a lot. The tax rate for super balances above 10 mil is going to go not just to 30%, but up to 40%, which incidentally is so 10% more. So 0 to 3 mil will be a combination of 15% or 0, depending on what you can put into a pension, currently $2 million. And then from 3 to 10 will be taxed at 30%, and 10 plus will be taxed at 40%. And basically, this is the government just saying, we do not want money in super above 10 mil.
It's not for wealth transfer.
Yeah.
Yeah.
And this won't make sense in most cases for Australians to have super balances above 10 mil if this legislation is passed and it's effective 1 July 2026, because you might remember that in superannuation, you only get a 1/3 discount on the capital gains tax. So the best capital gains tax outcome you're going to get, 40%, is down to about 27.
Yeah.
Now, bear in mind that that's equivalent to what you're getting in an investment company, or damn close. And you get a huge amount more flexibility with the investment company in terms of ownership, in terms of how you manage tax. Similarly, when it comes to a family trust, then the family trust can naturally pass capital gains tax on. You might be highest marginal tax rate, but you get a 50% discount. So your 47% goes down to 23.5, which would still be more favorable. So I think in almost all cases, you will be better getting your money out of super if your balance is above 10 mil. And this, for some Australians, this is going to hurt a lot, right?
And that's what they've talked about. There was a couple of articles in the Financial Review the week of this going live as well, which is that family trusts will grow, but more likely luxury property. Like, there's a store of wealth. You can just invest more money into your property if you're going to pass. Like, if you've got $150 million in your super fund, chances are that a vast majority of that is being passed to the next generation. So another way to do that is to hold luxury property. They've talked about that being one potential source. And I always like to think, how did you get that money into super? And it's interesting because a lot of the cases, I wouldn't be surprised if it's a company that is now a big Australian ASX listed company that you originally held most of your shares in your super fund, and it's gone exceptionally well, and now you've got these assets in there. But basically equalises as you said, equalises the tax rates, and means over 10, significantly over 10 million. I don't think you say 10 million, but if you've got significantly over 10, so probably 20, we can run the numbers on it for a different episode, then there's very little reason of having that excess in superannuation anymore. If you've got as we said, if you've got 10.1 million, 10.5, 11, 12, 13, you're probably not going to be too impacted by it. Your average tax rate is still going to be lower than the alternative. But as soon as you go significantly over that, which, as they said, I think it's only 8,000 only. I mean, I wouldn't want to be one of the 8,000 people, because
I would.
About to get either. Yeah, I mean, you're going to but you get used to not paying tax on that. Like, imagine if you could be getting a fully franked, if you've got 140 million in one company, you get a fully franked dividend of $2 million coming into super fund tax at 15%. That's,
Yeah, but this is just driving the share price down, the CBA share price. I'm happy about this.
Yeah, of course. So, yeah, they estimate that 90,000 will be hit by the $3 million tax, which we talked about, as of, I think, immediately. 8,000 by the $10 million tax. And that's clearly a target, a targeting wealthy and removing this use of superannuation as a wealth transfer vehicle for the ultra wealthy. I think it still makes sense.
We're going to conclude shortly, but what do you think about this proposal?
I found it interesting, and I'm going to have a little dig here, that part of the announcement that came out was that the government still hasn't worked out how they'll apply it to themselves. And every time we put a video of Div 296 on YouTube, it's always like, yeah, but they won't apply it to themselves. So they're trying to, but apparently they can't. It will apply commensurately to defined benefits, but they're still not sure how that will happen. I mean, we've seen this play out we've talked about on other episodes where we start off with a $1.6 million cap on pension balances. That's now up to $2 million. Basically, I don't know, and the government feels like they need to raise tax or put less incentive for holding large balances within superannuation. It makes significantly more sense than it did before, but it's just another means test to increase the tax rate from the high net worth or the wealthy. It's kind of if you think about it, it's a roundabout way of increasing tax on what would otherwise be inheritance or gifted assets for the period before they pass to the next generation. I think that's always on the cards, is this inheritance tax and forcing people to get money out of the tax effective environment. We know superannuation is built for you to take all the money out. as you get closer to passing, because the minimum pensions keep increasing as well. So I think it's much better than it was. And given the success of superannuation in Australia, it was inevitable that something like this would come.
Yep. Yeah, I think that's a good summary. I agree with you. I think my thinking around this has changed. In particular, I spent quite a bit of time looking through the submissions for the Productivity Commission. We've previously spoken about that in other episodes. That work is being done by the Labor government at the moment in terms of how to increase productivity in Australia. Really, a huge amount of the submissions really related to how we can capture more tax in Australia rather than how we can increase productivity. But there were some really, really well documented cases to demonstrate that the headwinds that a lot of accumulators face in Australia in terms of acquiring wealth, buying properties and building their own financial success is significant, and especially when contrasted with some of the huge free kicks that really wealthy, ultra wealthy retirees have in Australia. So if you're listening to this and you've got that super balance of 20 to 40 to 50 mil, then power to you, because that doesn't happen by accident. That's probably the product of some incredibly good decisions and some hard work and all of those things that have created that success. But I'm the same. I think change needs to happen here. And this for me was a real relief in the sense that I think the legislation is much more sensible.
Yeah.
I think it allows Australians to be better positioned and know where they stand without really ultra complex tax situations. And most importantly, I think I think overall it can be applied consistently for a number of years into the future. So we're not likely to, there's a good chance that this could be just the tranche for the next decade rather than tranche 1 into tranche 2 into tranche 3, and the complexity continues to evolve.
Yeah, I have to agree on that. It's more of the way it's structured now is more of a forward-looking policy as opposed to one that was just how do we raise tax now in the most aggressive way possible. I hadn't thought about what the implications were 5, 10, 15, 20 years from now.
Yeah. Now we're going to conclude here. What I'll finish by saying that what is baking my noodle a little bit is the cynicism that I'm seeing around a little bit, which is the argument of, did the Labor government with their huge majority intentionally propose these insane Div 296 or this policy at the beginning and then water it down so everyone says, oh, thank goodness, that's a better outcome than we thought, but you're still 15% worse than you were going to be otherwise. I'm not so cynical, but I just keep hearing people make the comment, like, if you were going to do it, like, Trump did it in Liberation Day. It's actually quite a common political strategy now across the world. And so hopefully that's not the case. I'd like to imagine that we're better than that. Who knows?
Let's hope so.
Thank you so much, everyone, for joining on today. A slightly longer session, but I think lots of really good value here. As always, please keep your questions coming to us. The next one we're going to do is Q&A, so we're really going to dive into some of those questions now. But happy Thursday to each and every one of you, and looking forward to chatting to you all soon.
Good to see you.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.